Well, welcome everyone to today's webinar. I appreciate you all tuning in today. We've got a great topic for you. We're going to be discussing tax planning through the 4 stages of retirement. And this is a very important topic and a concept that I believe not everyone thinks about. They think about retirement as one stage, and there's multiple pieces to retirement, multiple stages, and tax planning changes based on what stage you are in. Well, my name is Matt Wilson. I am the president and chief investment officer here at Keen Wealth Advisors, and we are a fiduciary financial planning and investment management firm headquartered here in Overland Park, Kansas. And we put on a lot of educational events. Today is a webinar on tax planning, but we do live events in our office where we go through similar topics. We also have a very popular blog and podcast called Keen on Retirement that you can find on our website, keenwealthadvisors.com, and then scroll over to the retirement resources page, and you'll find a link to all of our blogs, all of our podcasts, and also recordings of all of our webinars that we have put together. Our CEO and founder, Mr. Keen, he is an author. Second edition of his book is now out, Keen on Retirement, Engineering the Second Half of Life. There it is. And if you'd like a copy, please let me know. You can shoot me an email at mwilson@keenwealthadvisors.com, and I'll get one sent out to you. And then lastly, before I go into the presentation, we have a new YouTube channel, and I encourage you all to check it out, subscribe to it. We are putting out a lot of content on the YouTube channel and content that you won't find anywhere else. So if you can't get enough of my pretty face, well, then just go to youtube.com, type in Keen Wealth Advisors, and you will find more video of me on YouTube. So looking forward to that, and definitely want people's feedback too on what your thoughts on our YouTube channel. So let's talk about tax planning through the 4 stages of retirement. And I apologize too for my voice with the change in temperature, weather, some allergies and some sinus issues are kind of coming up to me. So if I do have to pause to take a drink of water, I'll try and do that as quickly as possible. But here we're going to start off with a little bit of a tax brain teaser. So here we have Bill, and he is single, he is retired, and he has taxable income of just under $49,000. To the right on this slide, I've got the tax brackets. And this is what the percentage tax you pay on your taxable income. So you can see he's in the 22% tax bracket based on his taxable income. Well, his taxable income is made up of 2 components. He's got IRA distributions of $40,000, and he's also receiving Social Security of $37,500. Well, you add those together, you might think, well, wait a minute, that's more than $49,000. Well, it's because the tax code doesn't tax all of your income. You've got a portion of your income that is tax-free. And, that typically is income that falls in the standard deduction. And then you also receive a portion of your Social Security tax-free. So that combination is what gets his taxable income down to $49,000. So the question is, he wants to take out $1,000 to go on to a road trip to go see a band. How much will he owe on that extra $1,000 distribution? Well, the most common answer that we receive is he'll owe $220, just on a federal basis only. He's in the 22% tax bracket. $1,000 would be in that bracket still makes sense. Nothing wrong with that answer, except it's incorrect. He will actually pay $407 in tax on that $1,000 distribution. Part of the reason the tax situation is the way it is because there's a lot of moving parts to it. The tax code is complicated. There's a different tax calculation for Social Security. You get some of your income tax-free via the standard deduction. If you itemize, you get even more income tax-free. There's tax on investment income. There's additional Medicare tax. The capital gains brackets are all different. And, the as much as Congress or the administration wants to talk about simplifying the tax code, that's not happening anytime soon. There's just too many moving parts to simplify the tax code. That's why we talk about this a lot too, because there's just so many different things that people need to be aware of when it comes to, optimizing their tax situation in retirement. And people end up paying more taxes unknowingly. They don't know. It's just, the way the system works. So there are 4 stages to retirement. And, people ask me, they're like, well, what are they? I talk about, early retirement, middle retirement, late retirement, based on, certain kind of age ranges and based on to what people are typically doing in those, in those stages. But the one that no one really thinks about is the pre-retirement stage. Prior to actually retirement, you need to be setting yourself up for retirement. And I was actually talking to someone here recently about this, and they had gone through and kind of calculated what they anticipate their future required minimum distributions to be. And they were looking at it and they were like, you know what? I'm going to have more income in retirement than I do right now. So I should be saving in the Roth 401k because, I'm in a lower bracket than I will be in the future. So that'll help me on a tax situation. Plus, no required distributions on that Roth portion. And 2, potentially even be converting money within my retirement plan to the Roth portion of the 401k. And these are all things, that we evaluate. We've got a lot of clients on today's webinar, and we're constantly looking at this for our clients. But folks that just aren't aware of this, they don't know. And you end up paying more taxes because you didn't know how, how this stuff works. There's a lot of things too you've got to be aware of in retirement. Inflation, that's been a very hot topic here the last several years. Inflation's been high. It's been, coming down, but it's still prices are inflating. They're not deflating. They're not going down. They're just increasing at a lower rate. So that just means inflation is lower. People are living longer. How does that factor in, especially when it comes to your health care? And then how does your spending change throughout retirement? That's actually next month's webinar. We're going to talk about retirement spending and how that changes for folks through the retirement years. One of the most important things, though, is in that pre-retirement phase, you've got to get an idea of what your after-tax income need is before you retire. For this individual that I was talking to, it's like, yeah, they knew what they were currently spending. They knew what they were currently saving. They figured out what their RMDs would be based on some, rate of return. It's a calculation, an estimate based on, what we expect to happen. And that was more money than they needed, but they also planned to spend it, but it also put them in a higher tax bracket. And so, they had done the work of thinking about this stuff, but they also, they weren't thinking about it soon enough. And, they had missed out on opportunities to put money in the Roth IRA at a lower bracket. They'll still be fine, but again, paying a little bit more in taxes ultimately than they should. Now let's move on to Social Security and Medicare, because there are different tax systems for Social Security and Medicare. So we've got to plan around that. So this is in, our early retirement phase now. Social Security kicks in for most people. You can start as age 62, you can delay it up to age 70. The decision for everybody is going to be slightly different based on whether they're married, life expectancies, health status, other income sources. All of that plays a factor into it. So let's talk through our example at the beginning. We had Bill, and he had his 40.7 tax rate. And I'm going to show you how this actually works. So you've got no extra income. So this is how his tax situation looked. He's got IRA distributions of $40,000. He's got his Social Security benefits that gave him his adjusted gross income, then his taxable income, and then his income tax. The extra $1,000. That's the only difference between the top two lines. But that increased his adjusted gross income significantly, which also increased his, relative to the $1,000 of extra income. Then his taxable income, and then his income tax on that. So there's the calculation. So looking at this, I've highlighted here these areas because that additional $1,000 actually triggered an increase in his taxable income of $1,850. So for every additional dollar of income, $1.85 was added to his taxable income, which increased his taxes. That's why he was hit with a 40.7% tax rate. $400 is because it increased the amount of his Social Security that he was paying tax on. So he was receiving more of his Social Security tax free. This extra $1,000 increased the amount or decreased the amount of Social Security that he was receiving tax free, increased the amount of his taxable income, and triggered a higher tax bill. Medicare has a similar calculation as well. When you're on Medicare, you can start that at age 65. And for most folks, if you're not working or not covered by a spouse's plan, you want to start it at 65. They penalize you if you don't start at 65. And they have a calculation based on your income from 2 years prior to determine what your Medicare premium is for the current year. So that sounds kind of confusing. So I'm going to show you an example here to kind of walk you through that. But they call that the Irma cliff. And you want to be aware because it's $1 into the next bracket, the next Irma bracket. It's a cliff. It triggers the whole tax. So here we have George and Martha. They're on Medicare. They have parts B, that's the healthcare coverage. D is the drug coverage. And they had a lot of income in 2022. $322,000. And this stands for modified adjusted gross income. So modified adds back in tax-free interest. So that's typically interest that you would receive from a municipal bond that you might own. And if you own that municipal bond outside of a retirement account, you receive that interest tax-free. Definitely at the federal level, possibly at the state level. They're going to sell a stock for $1,000 gain. So they're going to have a capital gain of $1,000 that's going to be added to their 2022 income. So now they're going to have $323,000 of modified adjusted gross income. So the question is, how much tax do they owe? Well, the capital gains rate is 15% based on their income. If your income is in the first two brackets or below the first two brackets, capital gains, long-term capital gains can be zero. As your income increases, capital gains triggers at 15%. And then as it goes even higher, capital gains can be even up to 20%. And then you have another 3.8%, net investment tax that's added when your income's over a couple $100,000. So the thought is, though, okay, so they'll pay on this $1,000 gain $188, 15% long-term capital gains, 3.8% investment tax because their income is so high. Well, let's go through the math on this. So here I've got the Irma brackets. So when your modified adjusted gross income from 2 years prior, so for 2024, your Part B Medicare premium will be based on your 2022 tax return. Base premium for everybody in 2024 is $174.70. And that's per person. So if it's a married couple, they're each paying that. As your income increases, whether you're single or married, you can see here the ranges. The amount of your Part B also increases per month. And again, that's per person. So you go through all this, you see, okay, well, they're prior to them selling that stock for $1,000 gain, they were in this third or second, Irma bracket, third tier, paying $349.40 per month per person. And this is just for the 12 months of 2024. And then in 2025, there's a new calculation based on your 2023 tax return. So if your 2023 tax return goes down and you're below the minimum threshold, well, then your Part B premium resets to the lowest amount. Because they sold that stock, it puts them now in this fourth kind of tier, which is increasing their Medicare premium by over $100 per month per person, just by getting $1 into that Irma bracket. So that's the cliff. This also applies to Part D, so your prescription drug coverage. So you pay the plan premium, which is different for everybody based on the drugs you take. But the extra you pay is additive to the plan premium based on your income. And these have the same income thresholds. So that increases for them from this third tier to the fourth tier, and that goes up by over $20 a month per person. The total, you can see here, for George and Martha, is over $3,000 in Medicare surcharges for selling that stock at $1,000 capital gain. So the total tax is $188. That still applies. And then the Irma surcharge, which is another $3,000, giving them almost $3,200 in additional taxes when they realize a gain of $1,000. So that $1,000 of extra income triggers almost a 320% tax rate. Now, they might have wanted to sell the stock either way, but now that we're $1 into that next Irma surcharge, we might look at other things too. Now, of course, they might have taxes associated with it, whether it's capital gains tax or income tax, if it's an IRA distribution. But if we're going to get into that next bracket, let's see if there's other things that we should be doing because we're already into that next bracket. The next thing we're going to talk about here is then knowing how to pull money out of our accounts in an efficient manner. This is an example, a common example. We have a couple here, Sam and Mary. They want to spend $8,500 a month, and they have a mix of accounts between IRAs, Roth IRAs, and then what we call after-tax money or taxable money. So the IRAs are all tax deferred. You put in money pre-tax, you're deferring the tax to the future. And when you pull the money out of the account, it's taxed as ordinary income. The idea being while you're working and saving, you're in a higher bracket while you're working, you're deferring all these taxes, and then maybe you're in a lower bracket or at least the same bracket when you're retired. Roth IRA, now those have only been around for just over 20 years or so. So not a short amount of time, but not as long as traditional IRAs and 401ks. That is money that is it's tax-free. You put in the money, you don't get a deduction for it, but then it grows tax-free. And as long as you're over 59 and a half and you've had the account open for at least 5 years, you can pull the growth out with no penalties and no taxes. And then this joint bank account, we call that kind of taxable, is you've paid tax on the money. So it's money you received on your paycheck. You didn't put it into a retirement account, whether it's IRA or Roth IRA. So you can invest it in what we call a brokerage account, whether it's in your name, joint name, trust. You can put it in a bank, and have it earn interest that way. And when you withdraw the money, you don't pay tax on any withdrawals because you've already paid tax on the deposit when you put the money in. You paid tax that year. You pay tax as you go. So interest that it earns, you pay income tax on ordinary income. If it's invested and you realize capital gains, then you pay tax on the capital gain. If you receive a dividend, you pay tax on the dividends. So that's how you pay as you go in a taxable account. So the conventional wisdom is that you spend your taxable money first. This is kind of how a lot of people think about this. So in Sam and Mary's example, you've got IRA, so that's pre-tax. You have your Roth IRA, that's tax-free, and then you have your taxable account, your joint account with $300,000 in it. And the conventional wisdom is, okay, don't touch your IRAs, just spend this bank account. Then, once that's exhausted or it gets down to a small balance that you don't want to go below, start pulling money out of your IRAs, traditional IRAs. And then the last is your Roth IRA, because it's hard to put money in the Roth IRA, and you want that to grow tax-free or tax exempt as long as possible. That's the conventional wisdom. But the way we think about it is slightly different. And the reason is because when you're in retirement, your tax bracket, changes a lot from when you're working, and you have a little bit more control over it. I mean, you don't have full control over it because you can't control exactly what the brackets are. And, Congress creates those, votes on those. You're forced to take distributions at a certain age, the required minimum distribution. So that limits some of your control too. But until those things change, like whether we know what the current tax brackets are. And if you're not at RMD age, or the age where they're forcing you to take money out, then it's like, okay, well, based on Sam and Mary's situation, we look at this and say, well, how do we optimize their tax situation? So first, we're still going to say, let's spend the taxable money first, the bank account, but also trigger some income by converting money out of the IRA to the Roth IRA. Because if all we do is just spend the taxable money and then don't do anything else, they're in a very low tax bracket. They're probably paying nothing in federal and state taxes. And we look at that as a missed opportunity. Because if we can convert money, so take it out of the IRA, immediately deposit in the Roth IRA, and only pay 10 or 12% federal tax plus state tax if they're in a state that taxes income. Well, we've just moved that into the tax-exempt, tax-free bucket at very low cost. So we're going to utilize those lower brackets when we can. This is also a strategy that works really well with delaying Social Security. If they don't need Social Security, if they're not, they don't have a health situation, if they're okay delaying it, delay it as long as they can, because that does have an income calculation associated with it. and then convert this money to a Roth IRA. And then once the bank account's exhausted, start spending the tax deferred money. And then lastly, the tax exempt money, which in a lot of cases is left to the next generation. Well, how do you think about a Roth conversion? So there's basically two ways to get money into a Roth IRA. While you're working, you can make contributions, and that's contributions to the Roth 401k if you have access to a Roth 401k, or if your income is low enough, there is an income threshold. Now, it's fairly high, but it does hit people. If your income is in the range to where you can make a Roth contribution while you're working, because you have to have earned income to do it, you can put money in that way. The other way, and this is for people, whether you're working or not, you can do this, is to convert money out of your traditional IRA into a Roth IRA. IRS is totally okay with that, and you don't have to be 59 and a half to do it. And the reason the IRS likes it is because you're generating taxable income in the year you do it. And you have to do it. It's the calendar year. So this is not one of those things that when you're looking at your tax bill or tax situation, like a lot of times this time of year, we're end of February here in 2024, people are getting aware, thinking about their 2023 tax situation because they're going through and filing their taxes. Well, Roth conversions have to happen in the calendar year. Contributions you can still make after the fact. Like you can still make a contribution for 2023. So that's one of the key differences. But this example, Jill, she's going to convert $100,000 from her IRA to a Roth IRA. That counts as ordinary income. So that'll be taxed at whatever bracket she's in. Well, how do we think about, should we convert money or not? Well, I talked, just a couple slides ago. Well, if we're in the lower brackets, for us, that's a pretty easy decision to make. We want to look at someone's lifetime tax picture, though. And that's part of what we do when we sit down with folks is every year we're looking at our tax planning tools and how do we minimize your lifetime tax picture based on, everything that we know and all the goals and objectives you're trying to accomplish. Well, each and every year, one of the first things we look at is, okay, well, what tax bracket are we in currently? So in this situation with Jill, she was in the 22% bracket. And think of the top of the bucket being, once you hit that and then you have more income, well, now you move to the next bucket. One of the easiest ways to think about this is, well, let's fill up the low buckets, 10, 12, 22, possibly even 24. Once we get past 24, it starts to get questionable whether there's as much of an advantage to converting. A lot of that has to be dependent upon what you think future tax rates are going to look like, because you're paying a lot of tax today as you move up into these higher brackets. And that's not, not a bad thing. It's just let's just be aware of how much tax we're paying today to do some of this. In the low brackets, yes. Again, much easier for us to analyze that and provide recommendations. As we get higher, we have to factor in a little bit more on the unknown side to just be comfortable with those recommendations. And we'll be able to calculate it and let people know so they're able to make a decision. But something to be aware of. Because some people might think, well, geez, if I want to put everything in the Roth IRA, which, hey, I don't blame you. It's just, how much tax are you willing to pay to do that? Other ways to think about Roth conversions is if we have a lot of deductions. So like if you're a business owner and you have a bad year, you have a loss, you can use those losses to offset IRA distributions. And those IRA distributions can be Roth conversions. So whether it's low sales, high expenses, whatever that looks like from the business side, you can use that to your benefit. Same with years with a lot of itemized deductions. So those are a lot, very high medical bills, and non-recurring, meaning you don't expect that to continue. If they're recurring, well then, once your medical expenses get over a certain threshold, you get to deduct them. And if you have on a consistent basis, year-over-year basis, a lot of non-recurring medical expenses, well then you're probably in a low bracket anyway. So you converting probably still makes sense, but one thing to think about is if you have a very high year. Same with like charitable contributions. If you make a very large charitable contribution, we can offset some of that with a Roth conversion, or vice versa. We want to convert a lot of money to a Roth IRA. Maybe this is the year we look at making a large charitable contribution, whether it's directly to a charity or to a donor advised fund. Also, before starting any income like Social Security or pulling distributions out of IRAs. Similar to my example earlier with Sam and Mary, we're living off the after-tax account, but in the meantime, we're also converting money to a Roth IRA. Other ways to think about your tax brackets, because, some cases, maybe someone doesn't have a large amount into an IRA and they're in a low tax year. Well, what else could we do? Well, if they have some life insurance policies that do have cash value, could we make some withdrawals from that on a tax-free basis? As I mentioned earlier, capital gains, if you're in the first two brackets, you could have very low or no capital gains by selling those stocks, and you can sell them and repurchase them, just reset the cost basis. And a lot of times there's no tax associated with that. And again, taking distributions from retirement accounts, whether converting them to a IRA or just pulling them out, reduces future RMDs as well. Now, as we progress through the stages of retirement, now we're in the middle stage, looking at different tax planning strategies. And one of these has really to do with charitable giving. There was a significant change in the tax code back in 2017 called the Tax Cuts and Jobs Act, which increased the standard deduction in such a way that most people now don't itemize, meaning they don't have enough expenses such as state and local taxes, charitable contributions, mortgage interest, medical expenses. Those are the most common to get you over the amount of the standard deduction to allow you to itemize, because everyone gets a portion of their income tax-free called the standard deduction. Here's an example. Albert and Shirley, they're in the 24% tax bracket. They give $5,000 to charity every year. And based on their other expenses, they only have $15,000 in itemized deductions, which is okay. Nothing wrong with that. That means they're not spending the money on mortgage interest, state and local taxes, healthcare. Those are things you're spending the money to get it as a deduction. Well, in 2024, the standard deduction for those that are over 65, because if you claim the standard deduction and you're over 65, you get an additional amount. That amount's $32,300. So anyone over 65, they have to have expenses over and above that to be able to itemize. So their $5,000 donation, they're not receiving any tax benefit by providing that donation. And they're going to do it anyway. What we look at is, well, how are we able to get them a tax deduction for this donation. So how can we accomplish that? Well, once you reach 70 and a half, you can utilize a strategy called a qualified charitable distribution, which we shorten for QCD. What that allows you to do is to take up to $105,000 out of your IRA, and that's each year, and send the money directly to a charity. And once you're at RMD age, which is now age 73, any amount that you take out under this QCD strategy counts towards your required minimum distribution. You don't get a deduction on your income tax, but because it went directly from the IRA to the charity, it also doesn't count as income. So think about that. Like if your required minimum distribution is $50,000 and you send $5,000 directly to the charity, well, your taxable income or the amount of your IRA distribution that you have to pay tax on is only $45,000. So that's how it reduces your income tax. Let me show you an example here of how this works. It's a very good strategy. So this is the traditional way. You send $5,000 to charity. You also, if you pulled out your required minimum distribution and didn't utilize this strategy, you put the money into your bank account. So it goes from your IRA to your checking account and then to the charity. Or if you're 70 and a half, either way, that counts as taxable income. And for our example here, they're in 24% tax bracket. Well, that's an extra $1,200 in federal tax. All they have to do is, instead of sending it from their IRA to their checking account and then to the charity, just skip the checking account part and send it from the IRA directly to the charity. $5,000 comes out of your account. Charity gets $5,000. The only organization that's missing out in this example is the IRS. They're missing out on $1,200. So definitely, if you're over 70 and a half and you're donating any money to charity, this is something to consider. Now, as we get into the late stage of retirement, thinking about estate planning. Estate planning is something that you have to think about throughout the whole process because, unfortunately, we don't know the date of death. So we've got to have our items in order, but definitely things to think about as you progress throughout retirement. Excuse me. Here we have an example of Phil and Mary. And this is a conversation, or this is an example of how the step up in basis works. So here we have this married couple. They have a taxable account, so they've already paid taxes on it. This step up in basis strategy does not apply to IRAs, whether they're Roth IRAs or traditional IRAs. Just applies to after-tax or taxable accounts. It's held in joint name, joint tenants with rights of survivorship, which is a very common way to hold joint accounts. Very similar to a trust account too, with two trustees. They have a good amount of money in that account. And of the investments, they have gains of $120,000. And unfortunately, Phil is diagnosed with a terminal illness. And he's given 18 months to live. Well, if they don't do anything, Phil passes away and Mary inherits the account. She gets the entire account because she's the joint tenant with right of survivorship. Well, because the account was titled in joint name, the step up in basis, meaning that when the account owner dies, any long-term capital gains go away. That's what that step up means. They step up to the date of death, the value, and eliminate that capital gain. Well, because there's two owners, only one of the account owners dies, it only applies to half of the gains. So in this case, $60,000. If Mary needed the money and she had to sell everything, she'd still have a taxable gain on, long-term capital gain on $60,000. I mean, it's not terrible, but there's definitely other ways to think about this. So one of the things that we would talk to them about is after the diagnosis, move all of the assets into Phil's name. So instead of it being a joint account, now it's just an individual account in Phil's name. Mary can have transfer on death to her. So it's the beneficiary, she's listed, so it goes directly to her. That's no issue with that whatsoever. And she can also have power of attorney over the account to where she can, act on behalf of Phil if she needs to, as long as Phil's living. Once Phil passes away, well, the account just transfers to her under the TOD strategy. Phil passes away 18 months later, the entire account is stepped up. So if she needs the money, now there's no tax on any of the sales. So just a slight little change there to minimize her tax liability. Also, it's important to make sure your IRAs, whether traditional, Roth IRAs, or any retirement accounts, 401ks, 403bs, whatever they are, life insurance policies, that you have the beneficiaries on the accounts and those beneficiaries are up to date. Because it doesn't matter what any will says or any trust says. The government goes by what the law goes by what the beneficiary form says. So it's important to make sure those are up to date. There's been some changes to beneficiary rules throughout the years, especially with the passing of the Secure Act. And, this all changed with Secure Act 1.0, which was signed into law December of 2019, became effective in 2020. But prior to that, and this is the rules actually, if you inherited an IRA prior to 2020, you're still under the old rules. They had a concept called this stretch IRA, meaning whoever inherited your IRA, if it was a spouse, they actually got to inherit it as if it was their own IRA, so treat it as their own, and that rule still is the same. But if you're leaving it to the next generation, or let's say your spouse is already gone, so your beneficiaries are your children. The stretch IRA was a rule that said your children could stretch out the balance of this IRA over their life expectancy, and they'd have to take out a small distribution every year based on, this calculation, similar to your required minimum distribution, but it'd be based on their life expectancy, which would be much longer, so the amount that they'd have to take out would be much lower. They could always pull out more, but they had this kind of small amount that they had to take out every year. Again, if you inherited an IRA under that situation prior to 2020, that still applies. That did not change. It only applies to people who passed away or inherited IRAs in 2020 or later. So now they have these different types of beneficiaries: eligible designated beneficiaries, non-eligible designated beneficiaries, and then non-designated beneficiaries. Non-designated beneficiaries, that's basically, if you didn't name a beneficiary, that's the easiest way to think about it. Or if you, listed a charity, so it just all went to a charity, and you said, or you didn't list anybody, just goes through to your estate. Well, there's certain rules how that is distributed. Non-eligible designated beneficiary, that's basically anybody that's a non-spouse, and most, it's certain trusts, but that's most trusts that are written fall under this category. And then eligible designated beneficiaries, these still have the old rules of the stretch IRA. So that applies to minors, disabled people, chronically ill, beneficiaries who are not more than 10 years younger. So most likely a sibling, not a child. Could be a friend, maybe you're not married, partner. Again, certain trust and spouses. So let's talk through each one of these. So non-designated beneficiaries, these ones typically have the harshest rules. Now, if you're leaving it to a charity, well, they don't pay any tax, so that's not an issue, and it just pays out. But if it has to go through to your estate, well, depending on when you pass away, if you passed away prior to you starting your required minimum distributions, they have to take everything out within 5 years. If you've already started your required minimum distributions, well, then they have your life expectancy. They just have to continue that same schedule until the account is exhausted. That's how that works. Not as common, but if you forget to put a beneficiary on there, they don't have a whole lot of choices. This is just how it works. For non-eligible designated beneficiaries, so these are what I say most non-spouse beneficiaries. So think of your children if you have any. If you're not legally married, things like that. And then, trusts, if they're written correctly, all fall under this. And most the estate planning attorneys we work with, their trusts are written this way. So it does apply. But the account, instead of having the life expectancy under the old stretch IRA rules, now they have to take out the entire balance by the end of the 10th year. So they have 10 years to defer distributions, but no longer than that. And at the end of the 10th year, they have to take it out. And that starts the clock starts when they inherit the account. They don't have to take anything out on a year-to-year basis. They just have to have it exhausted by the 10th year. Well, let me take that back. If you've already started your required minimum distributions and you pass away, they have to continue taking your required minimum distributions. They can always take out more, but then by the end of the 10th year, they have to take out whatever's left. That has to be distributed. And then the eligible designated beneficiaries, these are the individuals that, they still get the old rules, the stretch IRA rules. So spouses also have some additional rules too that I'll cover here shortly. But if the beneficiary's considered disabled, chronically ill, if they're not more than 10 years younger, or if they're minor children, then they're able to take out distributions based on their life expectancy. And they have that option for these three, disabled, chronically ill, and individuals not more than 10 years younger, for the rest of their life. The minor children, they can do it up until they reach age of majority. So they can take life expectancy distributions up until that age. And then once they reach that age, and age of majority is different based on the state you live in, but it's typically 18 to 21. Somewhere in that range is age of majority. Once they reach age of majority, the 10-year clock starts. So definitely something to be aware of. Well, how does the spouse work? Well, the spouse, they get some special rules, which is good. They're good rules. They get to roll the money into their own IRA if they have one. So you pass away, leave it to your spouse. They get to act like this is their account. Whatever age they are, required minimum distributions apply, don't apply at all based on their own account. Similar, if they don't have an IRA, they basically just treat the account as their own. So they open an IRA, move the account there, and then it's their own IRA. The other option is they can remain as a beneficiary. And this is an interesting thing. So they can say, I don't want to treat it as my own IRA. I want an inherited IRA. Well, why would someone want to do that? Well, if they're not 59 and a half yet, because if they're not 59 and a half yet, and they take the IRA, your IRA, and they treat it as their own, and they need money, well, now they're subject to the 10% early withdrawal penalty because they're not 59 and a half yet. If they treat it as an inherited IRA, that 10% penalty doesn't apply because the IRS says you have to take out, we're going to force you to take it out at the end of 10 years. So we're not going to penalize you. So in this case, the spouse can treat it as an inherited IRA, have access to the funds, still pay income tax, but not penalties. And then once they reach 59 and a half, and if they don't, they can just now move it from an inherited IRA to their own IRA. They can get rid of the inherited kind of wrapper, which is great. I mean, this is a very good rule for spouses when they inherit IRAs. Allows them access to the funds, avoids penalties, and then the rollover can happen to where they're not forced to take it out in 10 years, like the inherited IRA rules would say. Well, we covered a lot, and I appreciate you all joining me on today's webinar. Again, I apologize for my voice as well. I had to pause a couple of times for some coughs and things like that. So again, thank you all for joining us. And I appreciate all of the questions you all submitted ahead of time, the questions you submitted during the event. We'll make sure to cover those afterwards because we're getting towards the top of the hour. I look for those questions to be answered actually on a future podcast episode because that is where we cover a lot of those. But just remember this. There's 4 stages to retirement, and one of the most important stages is pre-retirement. It's before you retire. That's one of the stages. You've got to get aware of this stuff and how you think about it because it's important to have a tax plan because healthcare and taxes, those are the 2 biggest expenses people have in retirement. And can we minimize those? We can do our best, and we might as well at least try based on the rules that we have access to. So we want to optimize our tax situation. And remember, this stuff is complicated. Again, for all the clients that are on today's webinar, we appreciate you all for joining us. And our planning team we're looking at all this stuff for you. Part of our annual review process is, digging through all these things and seeing what opportunities exist. And those change from one year to the next. Sometimes they're consistent on a year-over-year basis. Other times, one year makes sense to do a Roth conversion, next year it doesn't. One year it makes sense to take a lot of capital gains, next year it doesn't. So we're always evaluating this and thinking about it. For those that aren't clients, we're happy to sit down with you, go through this process. Again, we have a great team here, a group of certified financial planners that can handle these questions, go over all this stuff for you. We're willing to do that at our expense as well. We don't charge for those meetings. Just a great way for us to sit down together and see if there's a fit for us to work together. And we'll share with you exactly how all that works. Again, check out our educational resources, keenwealthadvisors.com, go into the retirement resources tab. And then lastly, if you'd like a copy of Bill's book, whether the copy you have is maybe you gave it away or you'd like me to send a copy to someone else, we're happy to do that. Just send me an email, mwilson@keenwealthadvisors.com, and we will make sure and get that sent out to you. And then actually one more last thing, check out our YouTube channel. Go to youtube.com, just type in the search bar, Keen Wealth Advisors. You'll find our channel there. Again, a lot of great content that we're continuing to add to that on a regular basis, and videos and content that you won't see anywhere else will be on that YouTube channel. Well, again, thank you all for joining us today and looking forward to seeing you all at next month's webinar.